Hello everyone, and welcome back to another stock trading breakdown video from TrueTrade. Do you struggle at finding key levels on a given chart? Do you not know when and where to enter and exit a trade? Don't worry, this time around we'll be going over a popular question that many of you have. How to find key levels on a chart, or specifically how do I find my key levels and how you too could implement these same strategies to take higher probability trades. There are many ways a trader can find key levels or zones in a given chart, whether it be looking at level 2 data intraday, which is pretty effective, using some fancy indicator that tells them where buyers and sellers are, which hardly ever works, drawing no-nonsense trendline spider webs all across your chart, which makes it very difficult to even see your chart, or even just blindly listening to some random guy on YouTube or some trade guru telling you what you should look for without any explanation or logical reasoning. In short, there are many ways that traders can find their so-called key levels, with some being far more effective than others, as you've probably noticed yourself. There are quite a few different techniques I utilize to find key levels on a chart, but they all revolve around one basic principle, and today I will be sharing with you one of my top key levels finding strategies. Now you too can implement the strategy to make yourself a better trader. And trust me, implementing this strategy is far simpler and easier than most strategies out there, and it has pretty solid logical reasoning behind it as well. Plus, you don't need any fancy equipment, just a simple candlestick chart and the ability to access multiple time frames, as seen by this TD Ameritrade chart right here. So jumping right into it, the best and most easy way I find key levels on any trade chart is by identifying an important level around key consolidation zones. This practice can be done on any time frame, but I always prefer to start on a daily time frame and work my way down from there. In short, a consolidation zone is a zone where price goes sideways for an extended period of time and simply just where it has continued buyers or sellers stepping in over and over again. Let's get right into it, shall we? Take a moment, look at the SPY chart. There are quite a few good consolidation zone examples for this one. See if you can spot any of them. If necessary, pause the video and get back to us when we're done. Now that you're back, did you have any similar zones? These are just a few of the ones we've identified and the ones we'll be going over. It's okay if your zones are not similar, as we'll help you get a better understanding of why we chose these zones and why they're important. So the first example on the chart comes around 364. As you can see, there's a pretty clear consolidation visible here. Generally speaking, when I like to draw my consolidation areas, I like to draw zones. Especially for newer traders, it's much easier to look at a zone and identify an area where there could be potential buyers and sellers instead of having it to be right to the exact tick. In this case, here's our buy zone, consolidation zone. When we're under, sellers are holding under. When we're over, buyers are holding over. It's a very good example of a key zone. The key level is drawn at a breakdown candle. We'll go over the importance of breakdown and breakup candles in a later video, but the basic idea, sellers stepped in down, pushing price down on the first day, try to retrace up, sellers stepped in again, try to retrace up, sellers stepped in again. Once we gapped over, sellers are now out and buyers are in control, and that's where they form a consolidation. This is the consolidation, and notice anytime we came back towards it, buyers stepped in, because that's where they were accumulating over this period of time. Next up, we have an example that shows us how you can use a consolidation zone for an over-under level, and how drastic a flush can be if a consolidation zone breaks. In this case, SPY was at his all-time high. At this candle, new high made, starts consolidating 411, push up, new high, pulls back, where the buyers step in again, 411, accumulating, buyers are stepping in. New high, pull back, buyers step in again at the same accumulation of 411, new high, pull back, buyers step in again. But what happened here? This is a great example of what happens when a consolidation zone breaks. We broke 410 and flushed pretty quickly all the way down to 405. Nice $5 drop, pretty quick, pretty drastic. Why did that happen? Because all the buyers that were here, that's where they were positioned. Once that buy level broke, there were not really any buyers positioned until a lower price. And then sellers took control and pushed us lower. Great example. Over 411, buyers were in control. Under 411, sellers were in control. Because 411 was a good consolidation zone. Right? We got back over here. Buyers held, continue pushing up. And then we break back under, get to the bottom zone. This is also a mini consolidation zone. We had a 2-day hold here, followed by a hold here, hold here. Nice. Buyers stepped in again, pushed us back. Recap to 411, buyers are in control once again, and start pushing us higher. Try to pull back here. We don't get all the way to it. Buyers still hold, buyers are in control back over 411. Now, we're on to our final SPY example, the consolidation hold around 437. We drew the key level on this gap up. At this time, it was an all-time high. We'll go over the importance of gaps and how they could be key levels in a later video as well. But basically, as we see here, gap up, new high, pull back. We continue to hold this buy zone around 436.50 to 437.50. Continue to hold, accumulation of buyers. We step in, push higher, boom, new high, pull back. Nice pullback. Where do buyers step in again? 437.50. At a time in the morning, this was trying to hold under 437.50, but once we recaptured, buyers continued to accumulate. Once they're back over, those buyers take control. Boom, rocket right off here, new high, little pullback, new high. And we could also make a case that we're starting to get buyer accumulation over 450. And as long as now that 450 holds, we should continue to grind higher. Hope these few examples help, but we'll go over a few more on some other charts. For this next example, we utilize Disney. This is pretty similar to the SPY example, but it's over a longer period of time. As we can see, there was a lot of accumulation of buying happening around 171. Buyers accumulate, push up, come back down, accumulate, push up, come back down. We try to break, but buyers accumulate again. Buyers are stepping in very strong. With this 171 in mind, you can be looking to take a long trade anytime we come back into this zone. Of course, the trade is always not going to work 100% of the time, but that's part of trading. No trade is guaranteed to work, but by taking a good trade off a consolidation zone, we put the probability of success in our favor. Another example of this was NVIDIA. Buyers are accumulating off 187. It's not as clear, but buyers accumulating here, pull back, accumulate again here, and here. New high, off that pivot, pull back, where do buyers come in again? Accumulate here, and off this we make a new all-time high. Now, what if you wanted to do this, but on the other side? Piton gives a good example of how you can utilize the seller accumulation to take good trades as well. We have a down move, right? Accumulative sellers off 126, 127. Sellers are stepping in, sellers are stepping in, sellers are stepping in. Try to break. The closer we get to this zone, the higher probability that trade is to take a short. Sellers step in, pushes down again, right? Now we come back into it. We start to struggle a bit. Again, a good area to take a short trade. We're back at a key consolidation zone for selling. 127, seller stepping in, pushes lower. Step in again, push us lower. Great example of how this can be used in both ways. Now that we have gone through a few examples, hopefully you have a better idea of what to look for at consolidation zones and how to spot them and take profitable trades from them. Now we can get to the logic behind why consolidation zones are so effective. At the end of the day, it works because consolidation is either an accumulation of buyers or sellers taking in extended size. When buyers accumulate, that means more and more of them are stepping in. And more buyers are stepping in, it becomes harder for sellers to break that level. Same vice versa. When more and more sellers start stepping in, that means more sellers are present, and it's going to be more difficult for buyers to break that level. Think of it this way. If you're a football player trying to run through someone, would it be easier for you to run through one person or 10 people? The answer is pretty simple. One person. It's going to be much easier for you to run through one person than it is going to be run through 10 people because it's a numbers game at the end of the day. One person can only put a certain amount of effort to stop you, compared to 10 people can think of a number of ways to stop you, and likely make it impossible for you to even move. It's the same with consolidations. If there's 10 buyers at price X, it's going to be pretty easy to break through that level from the seller's point of view. Now if there's millions of buyers at price X, it's going to be pretty difficult for the sellers to break that level. As mentioned earlier, it's going to be very difficult for some of these key levels and key zones to break, but it's not impossible, which is why we always use appropriate stops to manage our risk. Let's go back to that football analogy. Say you're matched up against trying to run through 3 or 4 people this time around. You're still not likely going to be able to put up much of a fight and push through them, but some top-tier NFL running backs such as Marshawn Lynch or Derrick Henry could. Now in this scenario, what makes Lynch and Henry different than you, the average individual? They are different because they're more physically bigger, more skilled, and just stronger. And due to these advantages, they would have a much easier time trying to run through 3 or 4 others than the average Joe would. Now let's say there are a million buyers at price X. Is this level going to be hard to break? Most likely yes. In this case, the million buyers represent the 3 or 4 others trying to block you from running. Similar to you not being able to break the block of 3 or 4 other players, the average retail trader isn't going to be able to break this level because they do not have enough capital to get rid of all these buyers. But now let's say one big seller steps in. In the football analogy, this would be someone like Derrick Henry. And in this case, it would be a trader who has a lot more capital than the average individual. By being a larger trader, this individual could definitely break a consolidation zone and send us flushing down. And this is why this strategy won't always be 100% effective, because there can always be a chance that a big seller steps into consolidation zone to flush it, or a big buyer steps into consolidation sell zone to break it. But these scenarios are not really likely, which is why they work most of the time. Hope these examples with the football analogy really helped, and hope you enjoyed it. I will be dropping 2 more key level videos in the days to come. If you're interested in learning more about the stock market and staying up to date with our daily posts, go check our Instagram page and our website, and subscribe to our email list to receive a free actionable trading watch list every Sunday. Both are linked down below. Hope you enjoyed the video. Don't forget to leave a like and subscribe to the video to receive new video alerts. Have a wonderful rest of your day, everyone.